Welcome to TheoTrade. This is Don Kaufman. It's December 27th, 2024. There's just about an hour to go to the cash close here on this Friday afternoon. Of course, holiday week of trade. S&Ps are down some 63 handles right now, just over a 1% decline. But wow, we are way off of some of the session lows. Nevertheless, the bear is back in this marketplace and it appears hungry. Let me explain that and much more here, of course, on this TheoTrade weekend update. All right, well, let's kick it off with the Santa Claus rally. It's toast. Even if we rally back at this point, it's basically toast. And by the way, the Santa Claus rally is really the a few days after Christmas into basically, the first two trading days of the year. And it's not looking good at this point. When I say it's toast, like, look, let's bring up the spiders in this particular case and go to the daily chart. That bit of volatility that we had following the Fed just over a week ago continues to kind of resonate. And I'm going to talk extensively about just that the Fed, right? And that Fed meeting, which is this huge candle right there. It's obviously last Wednesday. That kind of volatility, as I say, kind of continues to resonate throughout the markets, which, again, I'm going to explain in quite some detail. And that is at the crux of what you need to understand about this marketplace. Nevertheless, let's come back to some of the intraday trade, some of the price action that we've seen this week. And, well, then just talk about markets moving into next week and obviously, the beginning of the year, which, of course, is next week. All right, so the S&Ps at this point have seen pretty considerable sell-side activity. I have to say, the cash open this morning, and that open is right in this neighborhood here, was just downright violent. And the S&Ps were down some 30 points at the bell, but we fell and fell hard. I mean, 50, 60 S&P handles like it was absolutely nothing. And moreover, the NASDAQ became what I term the bidless beast. I mean, this thing was absolutely, just take no prisoners for the first 30 minutes of trade this morning. And the NASDAQ was actually trading roughly at 21,850. And just briefly thereafter, just to point out, like 30 minutes into the day, we're already trading 21,628. I mean, 200 NASDAQ handles inside of like 30 minutes. It just got downright ugly today. And I don't, didn't expect it. And I don't think too many people did. Again, the volume was also magnificently large. And I'm pointing that out because the more you hear people like, oh, it's holiday trade and this and that, there's no holiday trade. Come on, it's an algorithmic marketplace. And when you're pumping, multiple minutes this morning, north of like 10,000 S&Ps, we're back over to the S&Ps, you're seeing 10,000 plus S&P contracts trade a minute. It's just downright serious. And we saw that this morning. It's just no question about it. Things got wild. You even saw volatility play a significant role. Now I'm going to do quite a deep dive into volatility towards the end of this video, but keep that thought kind of present in your mind because volatility really did react. And again, that's just not indicative. There is no more quote unquote holiday trade. Sure, and maybe a half a trading session that we saw like on Christmas Eve over there, but that's largely been reversed. So let me give it to you from a standpoint of what the price action looked like this week, right? So we're cruising over to the SPX, and the reason I'm cruising to the SPX gives you a very distinct view of what is a 3.5 trading day week. Okay, so right over here we have Monday out of the gate. We're a little bit bullish. On Tuesday, which is a half a trading session, markets actually ripped higher, and we ripped right to, if you will, the upper edge of the expected move. In yesterday's trading session, obviously we're closed on Wednesday. Yesterday being a Thursday, we basically sat directly on the upper edge of the expected move. And yesterday definitely saw some diminished volume, and then today, raging literally out of the gate, gapped like 30 points lower, literally touched the unchanged mark on the week, as I said, we've rallied back up. We are still technically right now higher on the trading week, but I do caution you, okay, right now, the volatility that kicked off, and I want to be crystal clear about this because when I say the bear is back and it's hungry, right, the volatility that kicked off from, okay, the Fed meeting um, continues right now. And there was a very, very stark contrast that really started, okay, during, again, this more significant down move. And the contrast in trade is all about higher degrees of correlation. And that's something I said, like, it has not dissipated. So there's been extremely high degrees of correlation. And I want to point that out because it's something that is being missed. Like there's, this marketplace gets popped, just this big sell-off, right? All of a sudden, you're a few days later than that. It's the holidays. Boom, we rally right back, and everybody basically waves the all clear. That's why I actually entitled this "The Bear is Back and It's Hungry." Okay, because even with the rally back, we're seeing really, really high degrees of correlation. And the reason I'm bringing the correlation into the equation is that crap didn't exist in any of the recent trade. Now, not in bullish days, not in bearish days. We just did not see high degrees of correlation. What I mean by that, and I want to be very specific with this, we have been seeing, okay, trading session after trading session, it's been kind of, tech versus, if you will, XLE, which is energy, and XLF, which is ultimately financials. I think that's the easiest way. And there's some other sectors, but it's really these two sectors. And we've been seeing these constant rotations. We're like into tech and then out of tech into, the financials and so forth. And those correlations, okay, they got snapped. And in the midst of volatility, you always want to look at this because it'll give you a much better feel. Like this morning, and I'm going to kind of clarify again, because I think this is one of the most constructive things you can do to understand where the marketplace is right now and where we're headed. But here in the S&P 100, this morning, we literally opened with 100 products down, no products up. The advanced decline line, okay, as the market was going down, the advanced decline line was actually getting better. At one point today, we saw 55 advancers, basically 45 decliners. And at that point, the market was no longer like the market opened down 32. By the time the advanced decline line got better, that's right, a better advanced decline line, the market was already down 60. And at that point, I'm like, whoa, this is not good. This can get out of control because what happens is tech is taking a big hit. And we learned something interesting today. If tech starts taking that hit, what it did is it demolished the advanced decline line. Okay, as the day progressed, tech started pulling the entire marketplace down. No one was rotating, and here we stand. With an hour to go, we're in a very, very high degree of correlation. And the point being, okay, you're starting to get that feel. No place to run to, no place to hide, right? We're not seeing sector rotation. That sector rotation may be done. And again, that's exactly what I'm kind of portraying here in my notes. Like there's extremely high correlations, especially at the cash open. The sector, okay, rotations. And that's looking for like, all right, so, well, look what happened this morning in the financials. Right out of the gate, as I said, the financials were screaming. They were trying to rotate to the financials right up until the point they smacked them. Okay, and they're going to hit them again into today's close. This crap is absolutely critical. Why? Because you're in a completely different marketplace than you were a few weeks ago. Completely different marketplace. The market couldn't correlate, but now that you're correlated, much larger moves are going to grip hold. Volatility, okay, is going to make a big comeback, and that's why I'm saying right now you got to be concerned because that bear is back and that bear is hungry. But you have not seen the bear, okay, inside of tech. But you are seeing it in other places, which is exactly what I'm about to get to. So again, the Santa Claus rally right now, okay, that goose got cooked. You know, the irony is the Santa Claus rally really amounts to like about 1.3%. And the irony of that is the S&Ps are off by about 1.2, 1.3% just today. So again, Santa's toast. You're getting much higher degrees of correlation, which just basically amounts to no place to run to, no place to hide. And you know, the craziest thing is when markets used to get hit hard, right? Trade would actually run and like buy bonds. The problem is no one wants to buy bonds right now. Look at this. No one wants to buy bonds. So you're seeing markets just kind of get decimated across the board. And it is like really intimidating to watch trade like this, because when I say there's no place to run to, no place to hide, the only thing people are buying right now is volatility, which again, I'll discuss here momentarily. So extreme correlation, sector rotation may be done. Now, let's look at some weak sectors. And before I even look at the weak sectors, I mean, obviously we can look at the bonds. The bonds are going to break, lows, which you should understand at that point, okay, that yields, right, the treasury yields, and that's looking at stuff like the TNX, okay, kind of continue to break out. In fact, you got to start pulling this up on like 15-year charts to see where interest rates really are, okay? We're threatening to see some of the highest interest rates in 15 years. In fact, let's just go to a max chart. Screw it, okay? You're very close to the highest interest rates, okay, that we've had since basically 2007. So we're looking at, decade kind of long time frames over here to even compare the 10-year. And in my opinion, the 10-year is going to continue to rip a little bit higher. Nevertheless, again, trying to get long some bonds, okay, but just nibbling at this point. Really, really important trade right now. So no one's going out there, okay, and rushing in to buy bonds unless the S&Ps are just getting decimated. And they're not getting decimated today. The S&Ps are down 1%. I mean, they killed Santa, but they're not getting decimated, okay? But as I was saying, there's weak sectors. And I want to start with the Dow and the Russell because they're just downright, they're horrendous. They look horrendous like this. And I'm going to start actually with the Russell and IWM specifically. This is what horrendous looks like. Okay. Granted, you just completely undid what was this huge, presidential election rally. Okay. It's over and done with. We literally started that presidential rally right in about that the 220 range, and we're right back there. So it gave back those gains, but that is not my cause for concern. It's just the element that, look at this, huge sell side activity, a bit of a bounce, and we're back into some sell side right now. Granted, on a year-to-date basis, the IWM is still going to finish the year relatively strong. It's up, some like 11%. I'm also going to look at the Dow. And again, I am not a big proponent of the Dow, okay? But it too looks horrendous right now. Some wild and unrelenting sell side activity. It gets a bid back under it, but it's already back into, all right, a bout of selling in here. So what gives? When I'm talking about weak sectors, generally speaking, the only thing holding this marketplace together right now, it's still tech, continues to be tech. I'm not going to diminish the ability for tech to carry the marketplace because it has been carrying the marketplace. There's no question, okay? But the real cause for concern now comes given the fact that we're seeing higher degrees of correlation. It's like tech is no longer the place like, you can run to. And you can see products like Microsoft, like this is not a good sign. It's still up 15% on a year-to-date basis, but the price action in Microsoft, okay, that's not positive coming into the end of the year. We'll look at Apple. Apple absolutely is. Apple has been unequivocally just unscathed. I mentioned this the other day in one of the evening videos, and I'm going to mention it again. If there's a place to short right now, like if you're looking at this marketplace, you're like, oh, he might be right. Like this thing might come down. You want to be short Apple. Okay. I don't care what you think about Apple. And there's no fundamentals in here. It's not about fundamentals anymore. Why? We're seeing high correlation. You think anybody cares about fundamentals? Okay. When they're selling stocks on a correlated basis? Okay. Do you think anybody cares about fundamentals when there's 87 products trading to the downside? And I'm deadly serious with this. Okay. There's no fundamental. Like this is not anything about other than sell side activity starting to hit the marketplace, right? And in bigger sell side activity, you see higher degrees of correlation. It's the bottom line. So if you want to get short something, it's probably Apple. You take a look at Amazon over here. Amazon, I would agree with as well. Amazon's only a stone's throw off its all-time high. Taking a look at Google, off its all-time high. Okay. These are areas that I stress, okay, and want to stress again, they're relatively unscathed. And unscathed is the area that you want to be on the short side if you feel the marketplace is going to take a hit, okay? Tesla. Tesla's volatility, in my opinion, is just too high to want to take the position. And of course, NVIDIA. NVIDIA bounced off the 130 level in a big way, meaningful way, all the way back up to 140. But we could see it actually threatening again the 130. I'll actually get more aggressive inside of NVIDIA. The cracks through the 130, and of course Broadcom. Okay, Broadcom continues to rally and hold very close to some of its all-time highs in here. Okay, again, what's wild about this is I'm already talking about the bear is back and it's hungry, and you haven't seen anything in terms of tech being hit. And I don't want to intimidate anybody, but you have to understand, okay? It's not about like overbought, oversold. It's like the S&Ps, okay? They've basically been unscathed because tech is holding the whole thing together. But as I said, there's like weak sectors. And if you look at the Dow and you look at the Russell, I think you would agree that that's a little scary, the Dow and the Russell, okay? Because they're not obviously tech heavy. But you start looking around and look at places like homebuilders, okay? This is a sector that, a few weeks ago was up 33% in a year-to-date basis, now up 11%. It's full-fledged bear marketplace. Okay, you look at, again, XLY. To be fair, XLY is like all Amazon and Tesla. So it's, literally like 50% of this thing is two stocks. It's probably not even worth having on my watch list. You look at the industrials, okay, how hard they've actually been hit. We're in corrective territory. You look at the XLU, okay, heavy correction in here. SMH, which is semiconductors. Interestingly enough, the semiconductors are not and had not participated in the rally, still up huge. Healthcare clearly got decimated. Healthcare is actually looks like it's going to finish the year flat to slightly down. Again, corrective territory. XLP starting to take a much more substantiated hit in some of the recent trade. Okay, XLB, all right. So this is actually materials getting decimated in recent trade, corrective territory. People, point I'm trying to make is it's everywhere. By the way, here's the XRT. This is kind of specialty retailer, not as big of a hit. Okay, again, it's got some tech in it. And then of course, XLK, which is technology, okay, at or near highs. People, it's tech and only tech at this point. And with higher degrees of correlation, in my opinion, it's the first real weakness that you're about to see in tech. And I want you to understand that it's not about just weakness of the broader marketplace. The broader marketplace is going to get pulled down. Okay, all the rotation in the world would not save the S&Ps if tech starts to sell. Okay, and this is again the first real shot we've had at seeing some sell side tech. Granted, okay, you're going to come into the first of the year next week and maybe see some big, big bids back to the marketplace or attempts at rally. Okay, but at this point, I am again very suspect with the higher degrees of correlation. Okay, let's do a little bit of a volatility check. So I'll start with VIX because people are a little bit more comfortable with VIX. VIX started taking back off today, cracking all the way up to like 18.5. Okay, subsiding to some degree, but quite frankly, got to understand, like it's a holiday trade. You would think that nobody would really feel the fear, except the fact that the VVIX also went totally nuts today, cracking over 114. All right. Pulled back a little bit to like 110, but you've got an incredibly high skew, okay? Skew that's basically 173. You got a VVIX over 100. You got short-term volatility that's amped. And probably, the mother of all of them, not so much looking at a chart on the VX, but the mother of all of them, okay, happens to be these volatility futures. And we've really, okay, changed up all right, vol a lot today. And that basically means I look at like the January versus February versus March. Okay. This morning, Jan versus Feb, which presently has 60 cents. Okay. It's in contango by 60 cents. This morning was actually 80 cents. So we've narrowed that substantially. And don't get me wrong, things have kind of mellowed out a little bit the closer we've come to this close. But this is still really rather heated. If there's one thing I will say in this, quote unquote holiday week of trade, okay, the volatility is really substantiated a lot of the movement you're seeing on the screen. Okay. And again, I am fairly intimidated given the fact that next week, again, you have a holiday week. The markets, by the way, are full days. Monday, Tuesday are full trading sessions. New Year's Eve is not a half trading session, it's full trading session. So you're open Monday, Tuesday, you're closed on Wednesday. Happy New Year! Then into Thursday, Friday, we're open. So we have 4 full trading days next week. It is a little intimidating to see the kind of price action in vol right now. So volatility has definitely come up in a meaningful way. All right, last but definitely not least, we cruise over to the SPX. And the SPX, okay, it's just a great gauge of kind of where you are. And the S&Ps are going to finish this year substantially higher. Asset managers all over, okay, is, basically they're going to claim, victory is mine, like I got it. We saw some pretty horrendous volatility obviously play out over the last 2 weeks. But what can you expect moving forward? Well, first thing I want to point out is we're coming off of a week. We just had 3.5 trading sessions with $101 of expected move, right? I mean, that's wild during the Christmas season, okay? What are we looking at to project for next week? Well, for next week, all right, going all the way out to January 3rd, we're looking at about an $84 expected move. So, okay, the volatility, even though the vol this week kind of raged, rightfully so, it saw some serious movement in the previous week. So vol is going to subside to certain degrees. By the way, that volatility, though, is not officially set, okay, until just after the close, till 15 minutes after the close. So there's still a lot of room for improvement on vol. So right now we're kind of near plus or minus like an $85 expected move. That will be for 4 trading days. Okay, still volatile? Absolutely. And I might suggest to you that number, if it does come out to 85, I would take the over. I mean, you got to recognize here we are on a Friday during a holiday week, and you're already seeing over $80 of movement. And the S&Ps at one point have been down well over 110 points today. So to say that an entire week, specifically next week, is only going to have $85 of movement seems extraordinarily light. Again, last trading days of the year, okay? And then the first trading days of the year will be next week. Doesn't matter that it's holiday trade. Prepare for some volatility. As I said, this marketplace, it's got some extreme correlations back into it, right? The Santa rally is toast, so nobody's even thinking about that. At this point, could be a little bit of survival, because it does appear a bit of the bear is back, and it's hungry. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.